Incredibly so. I mean, and it's very important to mention, I think, that this is really not going to be ending anytime soon. China is preparing for the long battle, and in fact for the worst-case scenario of a new Cold War. They feel that there has been a structural shift across U.S. government in policies towards China. They think that the U.S. is trying to contain China. They've talked about interest extortion, that the U.S. is using trade wars or the threat thereof to force open the markets there. And they've talked about model beatdown, attacking Chinese state capitalism, their model of development, to preserve American hegemony. So they feel that they're engaged in a multi-dimensional struggle akin to the Cold War.
Is this quite helpful in some ways to senior Chinese officials because they can blame this on outside attack rather than looking to what's been going on in their own domestic economy?
Well, in some ways, they are struggling, it's true, on the economic front. There are headwinds there. So, in fact, it's very important also to say that China's growth rates are homegrown. They're not the result of the U.S. tariffs. There are two factors, in fact, driving the slowdown there. So one has been the government's concerted efforts over the last 5 quarters to tighten credit and stabilize China's debt levels. And relatedly, there's also been a dramatic drop-off in investment spending by local governments. And so now China is trying to walk this very difficult tightrope of, on the one hand, not backing away from the deleveraging campaign, but on the other, to cushion the economy against these sort of weak fundamentals and, of course, these trade tensions.
And Joseph, not so long ago, they reintroduced the countercyclical factor for the currency. And I just wonder whether you read that as them sending a message that they're not willing to use the renminbi as a tool to combat the threat of the trade wars, a depreciation tool in that sense.
Yes, that's a very good point. Yeah, and that's exactly right. They're not willing to use it, and that's simply because of the risks involved. So as you may recall, back in 2015, there was a botched devaluation attempt, which led to increased capital outflows. They ended up actually burning through $1 trillion of their foreign exchange reserves in order to support the currency. And this is a similar issue now, and what they are fearful of, which is that on the one hand, of course, a depreciated currency helps them offset some of these tariffs. But if the currency is going to fall too far too fast, then they are concerned that investors may get frightened and they could see huge capital outflows, which is exactly what they don't want right now.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.